Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the Through the Noise. I am your host, Heung, a senior investment strategist within the CIO team. Today, I'm very happy to be joined by Manpreet Gill, our CIO for AMEE. Welcome, Manpreet. In the last couple of months, it seems that market is dominated by corporate earnings, oil prices, and related inflation fears. Now, earnings have been winning so far, but should investors start to worry about oil prices now?
Hi, Ray. Yes, you're absolutely right. If you look at market performance year to date, it certainly has been very much about earnings growth and the positivity around that, which has dominated, the narrative, and that, of course, has helped drive global equities to what are now close to double-digit gains year to date. However, you're right that renewed and I'd say almost ongoing U.S. threats of military action in the Middle East are starting to return the focus a little bit back to oil prices, and of course the risk of the resulting inflation around that. Now, when answering your question specifically, I think some perspective on oil and its impact on macroeconomics might be helpful at this stage. The Strait of Hormuz closure and the damage to energy facilities in the Middle East have thus far reduced global crude oil supply by approximately 20%. However, the impact on oil prices and market inflation expectations, as we know, have been more muted than what everyone feared at the start of the Middle East conflict. We think there are three reasons behind this. First, of course, that oil prices themselves are holding at lower levels when you think in inflation-adjusted terms compared to past oil price shocks. Second is that we know the world is considerably more energy efficient today compared to recent years and recent decades. And third, most interestingly, we've seen policymakers really make use of inventories around the world to help bridge the supply gap since the conflict started. Now, we do draw confidence from these three factors, and that helps us, take the view that a much worse energy impact. So, in other words, one we'd interpret as a shock that results in a significant impact on inflation can be avoided as long as the Hormuz Strait closure is relatively limited in length. And over here, when we say limited, the key here is the length being defined by how long crude oil inventories can continue to offset lost output from the Middle East. However, having said that, and I'm going to quote Trump here, time is of the essence. Several projections have argued that while inventories can help avoid a much larger oil price rise through early summer, a failure to resume supply shipments through the Strait of Hormuz before the end of summer do increasingly start to raise the risks that oil prices rise more sharply. That, of course, would be a scenario that would risk a bigger inflation and growth shock.
Thank you, Manpreet, for setting out this context. I think the equity market are now clearly less bothered by the risk insofar, and obviously, focus on the tech earnings. But in your view, can this extend, or do you see the risk of a correction?
Well, AI-related earnings, and particularly in the semiconductor subsector, have indeed helped drive a strong equity market rally. But I would say it's a relatively narrow one, disproportionately focused on that semiconductor subsector. From our view, we remain overweight global equities, given we are quite constructive on long-term earnings growth. But I will say that at this point in particular, we think it's time to broaden exposure beyond those narrow areas that which have led the earnings growth. This sort of broadening is not only expected to capture returns from a catch-up rally outside of semiconductors, but we think it's also a good way to help manage that risk of near-term volatility. I mean, we've got a strong earnings season, which we think is well priced, but given the previous conversation on oil prices and inflation risk, we've got these jitters on bond yields, which could, still drive a temporary, albeit meaningful pullback. Now, specifically within equities, when we talk about broadening of exposure, we think there are three strategies that can help achieve that broadening. First is to take some profit and rebalance towards laggards. So at a regional level, this was our logic behind trimming what was a prior overweight on Asia ex-Japan equities, which of course have significantly outperformed other major regions year to date. So trimming that back to core holding and rebalancing that towards euro area equities, which we raised to core holding from an earlier underweight. Within Asia, though, we're sort of holding on to our preference for broader exposure than through Chinese equities, Indian equities, and Taiwan equities, which, of course, is in contrast to year-to-date gains, which have been largely led by Taiwan and South Korean equities alone. So that regional rebalancing is one point. Second, of course, is within the US tech sector, we close our opportunistic idea on the semiconductor subsector. With the idea of broadening it to include other subsectors such as internet, which should benefit at this stage of the technology adoption cycle. We also open a new opportunistic idea on an equally weighted global equities. This, of course, should benefit directly from a broadening of the equity market rally. And finally, we close our overweight on the US utility sector. So that, together with the earlier measures, help keep our sector preferences spread across the US technology, communication services, and healthcare sectors.
Yeah, I guess, a related question on this then. As you mentioned, bond yields have been pushing higher recently. Why is that? And do you worry that this trend can continue?
Well, I think there are a couple of factors at work here, right? And before we get to oil prices and inflation, I point out that Kevin Walsh, of course, takes over as Fed chair, and of course that comes at a time when inflation worries, of course, are not far from the spotlight. But I also point out that several studies have argued that financial markets do tend to test new Fed governors early in their term on their commitment to fighting inflation. So that's most probably one factor, additional factor at work here. But having said that, we do take comfort in the fact that the most recent US inflation release certainly showed a rise in the headline number, but it also showed limited spillover of high oil prices into broader inflation measures. And also, of course, markets and long term inflation expectations remain capped. So, on balance, that's really why we see room for the Fed to stay on hold for a large part of the year, even if Kevin Walsh chooses to strike a somewhat more hawkish tone, at least in his initial days. Now, for investors in bond markets, we believe this context remains consistent with our current view to stay overweight emerging market bonds and balance that with an underweight to G3 government bonds. Uh, Again, I'll step back a little bit here to provide context behind that view. Between the two major drivers of returns in bonds, right? You can take on credit risk or you can take on duration risk. Today, we see more value in adding credit risk. Uh, the yield premium offered over government bonds remains most attractive for emerging market bonds in our view, and particularly since this universe already includes a significant share of commodity exporters, especially outside Asia. The duration risk, in other words, the risk of you take on when buying longer maturity bonds for the additional yield, actually looks far less attractive in our view. And there are a couple of reasons behind this. One is that we still think there's a relatively small gap between long and in yields between long and short maturity bonds relative to history. And so you're not really paid that well to take on that additional maturity. And second is that prices of longer maturity bonds are also more sensitive to inflation worries. So when you put that together, we just think that investors are paid to add bonds with durations up to about 5 to 7 years. That's where we see the most value, but not really so much on longer maturity bonds.
Thank you, Manpreet. I think finally, if we can have a quick word on gold, it is a popular safe haven, but has been surprisingly volatile recently. Are we still overweight gold?
Yes, indeed, we are. We are still overweight, and you're right that if you take a look at the very short term, sort of looking back in recent weeks, it's interesting that gold has become once again quite sensitive to bond yields. So we've seen gold prices fall when bond yields rise, and that of course reflects the more traditional relationship of the opportunity cost of holding the non-yielding metal at a time when yields rise. But having said that, from a long-term perspective, what is most important for us is that the data shows emerging market central bank demand for gold very much remains intact. So that to us is one important driver. And second, of course, just considering some of the downside scenarios that we discussed earlier, history shows gold can actually perform quite well in a stagflationary environment as well. So we still think that's a good hedge to hold against that specific type of downside risk. So putting that together, yes, acknowledging some of the very short-term challenges, but big picture, we think it still makes sense to remain overweight gold today.
Understood, Manpreet. Thank you. Now, if I can summarize in three key points of what we just discussed, I think number one is that earnings optimism has supported global equity so far, but the oil supply disruption in the Middle East could still lift inflation, especially if the Strait of Hormuz remain closed for too long a time. Secondly, the equity rally, in our view, can continue, but it could broaden beyond semiconductors to reduce correction risk from higher interest rate. And final point is that the bond strategy that we favor EM credit over long duration government bonds, and gold for us is still remain an overweight despite we have some short-term volatility. Now, thanks for tuning in, and we hope you find this episode useful. You indeed can now find more details in this discussion that we have just mentioned about in this global market outlook, which shall be now in your inbox. See you in the next episode of Through the Noise, and bye now. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.